This is your mortgage rate watch for Friday, February the 4th, and I'm Keith Akada with the Mortgage Reel. Taking a look at previous daily rate watches, we want to just point out to everyone we've been forewarning what's going on with economic data when it comes out. Well, if you look at the last 5 days, it's pretty much been a landslide in rates. Everything that we've had as far as a floor support and how high rates can go has just been broken. And that's not really good because we need to have these levels of support for the bond market to bounce back and then let interest rates ease a bit. At this moment, we're not seeing that. And there's been some big news that comes out we're going to talk about as far as unemployment report and what a new outlook is going to come in 2012 as far as the Federal Reserve. Oh, here's the news that's really pushing the rates. It's the unemployment report. What was expected to tick higher as far as the unemployment rate has ticked down. It has shockingly fell to 9% versus the previous month of 9.4%. This has got Wall Street just in a question mark right now. It's taking the money definitely away from the bond market, pushing it into Wall Street. But the real question comes up because of the fact that job creation fell, but unemployment also went down at the same time, which seems to be a little bit irrational, but they're selling on the news, and that's what's working right now. This is the real news that we're watching, though, and how this is going to play out for the rest of the year, and it's going to have pretty high impacts in the short coming. Yesterday, the Federal Reserve and Ben Bernanke talked about what their crystal ball is saying about the economy. But here's the biggest thing. With the unemployment report taking a sharp downturn today and what was totally unexpected by the market, it does question the possibilities of the quantitative easing 2 of the Federal Reserve and their action plans of injecting this full $600 billion into the economy. It is now being speculated by Wall Street if the economy does continue to improve at this pace, there's not going to be the need for the injection from the Federal Reserve, therefore taking it off. Well, the big thing that comes onto play now is if they take this off the table and the economy really is improving, the fear of inflation definitely does return overnight. With the fear of inflation, just as the Fed funds rate in the futures, and what this means is everything with the economy, Wall Street, anytime there's an announcement, anything that happens, it's human nature, and there's always speculation. Well, being the biggest gambling market in the entire world, Wall Street is all about the gamble. And what happens with speculation comes the opportunity for people to start hedging bets. Well, the bets are being hedged on right now is that previous to yesterday's announcement from the Federal Reserve and today's announcement of the unemployment report, the chances of the Federal Reserve raising their Fed funds rate for all you home equity line of credit owners out there and that variable line off the Wall Street prime, well, the chances of them raising that rate was only a 52% chance. As of today, with the unemployment report coming out, by January 2012, there's now a 100% chance that there's going to be a federal rate hike. This is extremely important to our market because that signals that inflation is definitely a concern on the horizon. And with increasing rates of the Fed funds rate, anyone that has a home equity line of credit is going to see their monthly payments go up overnight. More to come from Homeowners Education 101 as we put the final touches on the 2011 forecast for housing and mortgage rates. Leave any comments or feedback below as it's not only appreciated by Team Mortgage Reel, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks and like us when you're there. Otherwise, we'll be back tomorrow with more updates on your mortgage rate watch.